Robert worked for 38 years as a civil engineer in Ohio. He retired at 64 with a traditional IRA worth $480,000, a brokerage account with $220,000, and a house he bought in 1998 for $95,000. That house is worth $410,000 today. No mortgage. Paid off completely. His daughter Sarah was 39, working in tech, smart with money. She asked her dad one afternoon if he had thought about estate planning. He had not really. He had a will from 2009. So Robert did what a lot of careful, generous fathers do. He decided to start giving Sarah assets now. He did not want her to wait until he was gone. He wanted to see her benefit from what he had built. He called his accountant, asked if he could gift Sarah the house, and the accountant said yes. So he did it. He transferred the deed. He thought he was doing something kind and smart, something that would simplify everything later. 3 years after Robert died, Sarah sold the house. She listed it for $430,000 and accepted an offer at $425,000. Then she got a letter from her tax preparer. Her capital gains on that sale were $330,000. That is the sale price of $425,000 minus her father's original purchase price of $95,000. That is the basis she received the day Robert signed over the deed. Not the value of the house when he gave it to her. Not $410,000. Not $425,000. $95,000. The price her father paid in 1998. Her federal and state capital gains tax bill came to just over $75,000. Robert did not make a careless mistake. He made a careful mistake. He knew about estate planning. He called his accountant. He followed the rules. He just gave his daughter the wrong asset in the wrong way, and it cost her family $75,000 that never had to leave. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin, and this is Kevin Retirement Strategy. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today I am going to walk you through exactly why the IRS treats assets you gift during your lifetime differently from assets your children inherit after you are gone. I am going to explain the rule that creates this difference, which is one of the most important rules in the entire tax code for retirees. I am going to show you the exact dollar math behind the $75,000 figure in real numbers using the 2026 rules. I am going to explain how the 2026 estate planning environment has changed and what it means for your decision specifically. And I am going to give you a clear, practical action plan based on what you own, how long you have owned it, and what your children will actually do with it. This is not a complicated strategy. Once you understand one concept, everything else clicks into place. But the people who never learn this concept, and there are millions of them, are making the exact mistake Robert made every single year. Let me start with the concept that changes everything. It is called basis. Basis is the IRS word for what an asset cost you. When you buy a stock for $10,000, your basis is $10,000. When you buy a house for $95,000, your basis is $95,000. Basis is the starting line. When you sell an asset, the IRS calculates your gain by subtracting your basis from the sale price. If you sell something for $425,000 and your basis is $95,000, you have a gain of $330,000. That is what gets taxed. Now here is where it gets important for retirees specifically. The IRS has two completely different rules for what happens to basis when you transfer an asset to someone else. And the rule that applies depends entirely on one thing: whether you transfer it while you are alive or whether your child receives it after you pass away. Rule number 1 is called carryover basis. This is the rule that applies when you gift an asset to someone while you are still alive. When you give your daughter the house, she does not get a fresh start on the basis. She gets your basis. She carries it over. Your $95,000 purchase price from 1998 becomes her starting line. Everything the asset has grown since 1998 is still sitting there, waiting to be taxed the moment she sells. You did not eliminate the gain. You handed it to her. This rule comes from Section 1015 of the Internal Revenue Code. Rule number 2 is called stepped-up basis. This is the rule that applies when a child inherits an asset after you pass away. When your daughter inherits the same house through your estate, the IRS resets the basis. Not to what you paid, not to what it was worth when you bought it, to what it is worth on the day you die. If the house is worth $410,000 the day you pass away and she inherits it, her basis is $410,000. If she sells it the next day for $415,000, her taxable gain is $5,000, not $330,000. This rule comes from Section 1014 of the Internal Revenue Code. Here is the mistake in one sentence. Gifting a highly appreciated asset while you are alive hands your child the tax bill. Letting them inherit it after you are gone erases it. Same house, same daughter, same sale. Two different rules. $75,000 difference. Now let me put the exact math on this so you can see every number clearly. Robert bought his house in 1998 for $95,000. That is his basis. By the time he gifted it to Sarah, the house was worth $410,000. When Robert gifted the house during his lifetime, the carryover basis rule applied. Sarah received his $95,000 basis. 3 years later, she sold the house for $425,000. Her gain is $425,000 minus $95,000. That is $330,000 in taxable gain. At a combined federal and state capital gains tax rate of approximately 25%, which is realistic for someone in Sarah's income bracket in most states, the tax on $330,000 is $82,500. That is money Sarah paid to the IRS on a house her father gave her. Now run the same scenario the other way. Robert keeps the house. He passes away with the house in his estate. The house is valued at $410,000 on the date of his death. Sarah inherits it. Her basis is now $410,000. She sells it 3 years later for $425,000. Her gain is $425,000 minus $410,000. That is $15,000 in taxable gain. At the same 25% rate, her tax is $3,750. The difference between gifting the house and letting her inherit it is $78,750 in taxes. That is where the $75,000 figure comes from. It is not a penalty. It is not a fine. It is the entirely predictable, entirely legal result of using the wrong rule on the wrong asset. And it happens to thousands of families every year because nobody explained the difference before the gift was made. Now think about Sarah for a moment. She sold the house. She moved the money into her own accounts. And then the tax bill arrived. She did not blame her father. She told people he was generous and thoughtful. She had no idea the mistake had happened until it was already irreversible. That is the cruelest part of this trap. It does not announce itself. There is no warning letter. There is no moment where someone sits you down and says, before you sign this deed, here is what this will cost your daughter in 10 years. The cost shows up quietly, years later, on a tax return. By then the deed has been signed, the house is sold, and the money is gone. Robert never knew. Sarah never blamed him. But the $75,000 left the family. Now let me explain the 2026 context, because the estate planning environment has changed, and it changes one specific thing for your decision. Here is what matters for you directly. In 2026, under the framework of the One Big Beautiful Bill Act, the individual estate tax exemption has increased to $15 million per person. For a married couple, that is $30 million before the federal estate tax applies at all. The annual gift tax exclusion for 2026 is $19,000 per recipient. A married couple can give $38,000 per year to each child without any gift tax filing and without touching the lifetime exemption. Here is why this directly affects your decision about what to give and when. For most of the last decade, some retirees with large estates had a real reason to gift appreciated assets during their lifetime, even knowing the carryover basis problem. The fear was that dying with a large estate would trigger a 40% estate tax. If you had $20 million in assets and the exemption was $13 million, gifting appreciated property now meant triggering capital gains later, but it reduced the estate tax at death. Sometimes that trade made sense. In 2026, with the exemption at $15 million per individual and $30 million per couple, that calculation has changed dramatically for most families. If your total estate is below $15 million, and that describes the overwhelming majority of American retirees, The estate tax is simply not the concern. You do not need to gift appreciated assets early to escape estate tax because you are not going to owe estate tax. That means the only reason to gift an appreciated asset early, for most families, has disappeared. And the cost of doing it anyway, the carryover basis problem, remains exactly as large as it has always been. The 2026 environment makes the rule clearer, not more complicated. For most retirees, the right approach is simpler than ever. Do not gift your most appreciated assets while you are alive. Let your children inherit them and let the stepped-up basis do its job. Now let me walk through 3 types of assets most retirees own and tell you exactly how the rules apply to each one. The first type is a highly appreciated asset. This is anything you bought a long time ago that has grown significantly. A house, stocks you bought in the 1990s or early 2000s, shares of a company you worked for that you received as compensation years ago, real estate you inherited from your parents. For these assets, the stepped-up basis at death is worth an enormous amount of money. Every dollar of that gain that exists at the time of your death disappears for capital gains tax purposes. Your child inherits the asset with a fresh basis at current market value. They can sell it immediately and owe nothing on decades of growth. For these assets, gifting them during your lifetime is almost always the wrong move. You are handing your child a tax bill along with the asset. The carryover basis transfers the entire history of that gain directly to them. Robert's house was this type of asset. He bought it for $95,000. It was worth $410,000. The gap between those two numbers, $315,000 of embedded gain, was exactly what the step-up would have erased at death. Instead, Sarah carried it. The second type is a cash equivalent asset. This is money in a savings account, a money market fund, a CD, a checking account. Cash has no appreciation problem. If you give your child $50,000 in cash, there is no hidden tax bill attached. The basis is $50,000. Cash transfers work perfectly fine as lifetime gifts. For these assets, gifting during your lifetime is entirely appropriate, especially using the annual exclusion of $19,000 per recipient to keep everything clean. The third type is a low appreciation asset. This is something you bought relatively recently or something that has not grown much. Stocks you purchased in the last few years that are up modestly. A property you bought at close to its current value. These assets have small or no embedded gains. The difference between carryover basis and stepped-up basis is minimal. Gifting these during your lifetime is reasonable because the basis difference is not large enough to create a significant tax problem. The rule is simple. Gift assets with little or no appreciation. Hold assets with large appreciation and let your children inherit them. There is one more dimension to this that most people have never heard explained, and it directly affects anyone who owns appreciated stock in a taxable brokerage account alongside a traditional IRA. The stock your children inherit from a taxable account will have a stepped-up basis, but the money inside your traditional IRA will not. Here is why this matters. Money inside a traditional IRA is pre-tax money. When your children inherit your IRA, they inherit the income tax obligation on every dollar that comes out of that account. An inherited traditional IRA requires the beneficiary to withdraw all the money within 10 years of your death under the current rules, and every withdrawal is taxed as ordinary income. So if you have $300,000 in appreciated stock in a taxable brokerage account and $300,000 in a traditional IRA, the two assets are not equal from your children's perspective, even though the numbers look identical. The brokerage account, because it holds appreciated stock, will get a stepped-up basis at your death. Your children could inherit $300,000 worth of stock, sell it all, and own nothing. The IRA will be fully taxable. Every dollar your children withdraw is ordinary income. Over 10 years, that $300,000 could cost them $60,000 to $90,000 in income taxes, depending on their bracket. This is why the question of which assets you gift and which you hold until death is inseparable from the question of how your different account types are structured. The planning strategy that flows from this is to do Roth conversions to reduce the traditional IRA balance during your lifetime, while simultaneously holding your most appreciated taxable assets until death to let your children inherit them with a stepped-up basis. You are doing two things at once. Reducing the tax burden in the IRA by converting now at your rate, which may be lower than your children's rate, and preserving the step-up benefit on your appreciated taxable assets by keeping them out of lifetime gifts. Now let me bring Robert's story back one more time because it shows exactly how these two mistakes can stack. Robert had a $220,000 brokerage account in addition to the house. He had owned many of those stocks for over 15 years. He never gifted the brokerage account to Sarah. He held it until death. She inherited it with a fully stepped-up basis and sold everything with almost no tax consequence. He got that one right, completely by accident. He gifted the house, which was his largest appreciated asset, and that is where the $75,000 mistake happened. If Robert had done the opposite, kept the house and gifted cash or low-basis assets, Sarah would have inherited both the house and the brokerage account with stepped-up basis on everything that mattered. One decision, one asset, $75,000 difference. The brokerage account he kept was worth less than the house. But because he held it until death, it cost Sarah nothing in taxes. Because he gifted the house, it cost her $82,500. The size of the asset was not the issue. The type of asset and the timing of the transfer was everything. There is a strategy that allows retirees to maintain control of appreciated assets and still plan effectively for the transfer. It is called a revocable living trust. A revocable living trust does not transfer your assets to your children during your lifetime for tax purposes. Because the trust is revocable, you maintain control. The assets inside the trust are still considered yours by the IRS. When you pass away, the assets in the trust transfer to your children according to the terms of the trust, and they receive the stepped-up basis just as they would if the assets had passed through a will. The advantage over a will is that assets in a revocable living trust avoid probate. Probate is the court process that validates a will and oversees the transfer of assets. It is public, it takes time, it costs money and legal fees, and it is entirely avoidable with proper planning. A trust transfers assets directly to your beneficiaries without court involvement. Robert could have established a revocable living trust that held the house. He could have told Sarah that she would receive the house through the trust when he passed. The house would have stayed in his control for his entire lifetime. And at his death, the stepped-up basis rule would have applied completely. The $75,000 tax bill would never have existed. The trust is not a complicated instrument. An elder law attorney or estate planning attorney can draft a basic revocable living trust and fund it properly in a straightforward process. The cost is typically $1,000 to $3,000 depending on complexity. For a family with appreciated assets, it is one of the highest return investments in all of retirement planning. Here is your action checklist. Specific steps based on exactly where you are right now. If you have a house, a piece of land, or any real estate that you have owned for more than 10 years, stop before you transfer the deed to anyone. Calculate the difference between what you paid and what it is worth today. That gap is the embedded gain. Your child will pay capital gains tax on that entire gap if you gift it during your lifetime. Keep it in your estate. Let the step-up work for them. If you have stocks or mutual funds in a taxable brokerage account that have appreciated significantly, apply the same thinking. The difference between your purchase price and current value is the gain that disappears if your child inherits instead of receives as a gift. These are among the most powerful assets to preserve until death specifically because the step-up eliminates potentially decades of growth in a single moment. If you want to give your children money now while you are alive, give them cash. Give them recently purchased assets with little appreciation. Give them assets where the basis gap is small. These transfers do not create the carryover basis problem because there is no large embedded gain to pass on. Use the annual exclusion. In 2026, you can give $19,000 per recipient per year without any gift tax filing. A married couple can give $38,000 to each child. Over 5 or 10 years, this is a meaningful amount of wealth transferred with no tax consequences and no basis complications. If you have not yet established a revocable living trust, make an appointment with an estate planning attorney this year. Not because your estate is too large or too complicated. Because a properly funded trust eliminates probate, preserves the stepped-up basis on your appreciated assets, and gives your children a cleaner, faster, less expensive path to inheriting what you have built. If you have a traditional IRA, consider the Roth conversion window seriously. Every dollar you convert to Roth at your current tax rate is a dollar your children will not have to withdraw as ordinary income under the 10-year inherited IRA rules. You pay the tax at your rate now. They avoid paying it at their rate later. And the Roth assets you build do not affect the stepped-up basis calculation on your taxable assets. Review your beneficiary designations on every account. IRA beneficiary designations, life insurance policies, brokerage transfer on death designations. These transfer assets outside of your will and outside of your trust. Make sure they reflect what you actually want and that you understand the tax consequences for each named beneficiary. Let me close with the thing that matters most about Robert's story. He was not uninformed. He was not careless. He made a phone call to his accountant before he transferred the deed. He followed the process. He did everything a responsible person does before making a major financial decision. The accountant confirmed that the gift was legally permissible, and it was. Nobody broke a rule. Nobody made an error in the narrow technical sense. What was missing from that conversation was the question Robert did not know to ask. Not can I do this, but what is the long-term tax consequence for Sarah when she eventually sells? The accountant answered the question that was asked. Robert did not know there was a different, more important question sitting right next to it. That gap, the gap between what people ask and what they need to know to make a fully informed decision, is exactly what this channel exists to close. The rules on basis have not changed. Section 1015 and Section 1014 have been part of the tax code for decades. The stepped-up basis is not a loophole. It is the designed result of a deliberate policy choice that Congress has kept in place because it recognizes the value of encouraging people to hold assets rather than churn them. It is one of the most powerful, legitimate tax advantages available to any retiree, and it requires no special product, no financial advisor relationship, and no complicated strategy to use. All it requires is knowing that it exists before you make the decision to give an appreciated asset away while you are alive. Robert's $75,000 was not lost to fraud. It was not lost to a bad investment. It was lost to a decision made without complete information. His daughter Sarah would have received the same house, in the same neighborhood, with the same memories attached to it. The only thing that would have been different is whether she paid $3,750 in taxes when she sold it or $82,500. That difference was entirely within Robert's control. The moment the deed was signed, it was not. This is Kevin Retirement Strategy. If this video helped you see something about your own assets that you had not considered before, hit the like button right now and share this with anyone you know who has a home they have owned for a long time, appreciated stocks, or adult children they are thinking about helping financially right now. Tell me in the comments. Have you already gifted an appreciated asset to a child and now wish you had known this rule first? Or are you currently in the planning stage and trying to figure out what the right move is? I read every comment, and the situations that come up most often become future videos.